Ed Yardeni is president at Yardeni Research. He's with us to take some questions. Ed, good morning. Great to have you with us here. Thank you. So, Powell, all about just confirming what you've been saying for a while, Ed, that rate cuts are coming. And it's just, is it, I mean, 25, 50, doesn't matter. And do you think the equity markets will like 25 better, actually?
Yeah, I think so. I think the equity markets would like to see interest rates drop gradually, not abruptly. Abruptly would suggest that the Fed knows something that we don't know. Remember, it was only at the beginning of August that when the stock markets took a dive on the unwinding of carry trades, that there were some hysterics out there saying that the Fed had to lower interest rates immediately by 75 basis points. So I don't think the Fed wants to signal that there's any trouble out there, because there really isn't. And 25 is enough in September, and I think then they should wait. I don't think they should do another cut in November and another one in December. I think they need more data to confirm what the status of the economy is. And I think the economy is going to surprise everybody to the upside. I think it's going to be stronger than expected. And if that's the case, then there's absolutely no rush to lower interest rates.
Okay, so Ed, hi, great to have you on. So if you could expand on that.
Thank you.
So we get that first cut in September, and then are you saying that we'll keep getting gradual rate cuts with a strong economy? So then what I'm hearing is that Goldilocks will dance into the end of the year. Is that the market scenario we're looking at?
Well, I think the markets are expecting 3 cuts in the federal funds rate between now and year end. I think there's a likelihood that we'll only get one of those cuts in September, and that the economic news will look so good that the Fed will conclude that, maybe rushing interest rate cuts isn't the best thing to do.
Word on all the political rhetoric that's now heating up. And we know that, there's this big talk about raising corporate taxes, which is the stated sort of policy objective by Ms. Harris. We've not seen the market react too much to that. So what should we be prepared for in terms of just the market reaction, the equity reaction to what's happening in politics?
Well, honestly, that's been my position, is I'm not going to react to it until I know exactly who wins, not just who wins in the White House, but what the makeup is in Congress. Clearly, if we get a Democratic sweep, that's one set of policies that will be very likely suddenly. We get a Republican sweep, it'll be the other way. I think we're going to get what's called gridlock. I think whoever's in the White House isn't going to find it that easy to get things through Congress. If that's the case, then all of these policy suggestions may not even have a chance of occurring.
Hi, Ed. Good morning and good to see you. When Ed, I recall earlier this year, we were talking about the S&P 500 moving to around 5,400. I think that was the target that you had, that 4,800 to 5,400. We're currently at around 5,600. Where do you see the U.S. markets go by the end of this year? And also, I want you to comment on the geopolitical issue, Ed. It seems that the equity markets are just ignoring that. Your comment out there.
Yes. Yeah, the equity markets are ignoring the domestic political situation. They're ignoring the geopolitical situation. They're just focusing really on the Fed, inflation, the economy, earnings, and those are all positive right now. I'm thinking now that we could get to 5,800 by year end. I am actually concerned about a melt-up. The problem with a melt-up is it's hard to really put in any sort of target because you don't know. It's all kind of becomes psychological. And I think Powell actually made a mistake. I think he was too dovish on Friday. He should have basically signaled that September there'd probably a rate cut, and then we'll see. But he seemed to be really putting a lot of weight on concerns about the labor market, and I don't see that there's a lot of reasons to be concerned. Even he admitted that whatever increase we've seen in the unemployment rates has not been related to layoffs. It's just been more people coming in to the labor market thinking that there's job opportunities out there, and it's just taking them a little longer to find those jobs. So I think he was too dovish, but it doesn't really matter what I think. What's important is what he says, and what he said was very dovish.
No, it matters what you say, Ed, because markets listen to you, and we do too. Thank you very much for joining us.
Thank you.
And running us through what you are what you think the Fed will do, and your assessment of the entire situation. Ed's been sort of bang on over the last many months with this assessment through the sort of waxing and waning in terms of rate expectations, up and down. It's gone on and on, but he's been on the ball.